In this week's update, the best way to negotiate the gross uncertainty. What are the highest probability plays? And what sector has the most compelling value and outlook? My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information presented here is for general advice only. All right, this is going to be a shorter video than has been the case the last couple of weeks. Hey, it's Easter, so let's get on and do other things. But nevertheless, an important week in the market. Not a lot of change, not a lot of movement. And the US sector leadership, though, has clearly shifted. And you can only really make that assessment when you look back over 3 or 4 weeks or more. But clearly, technology, there is a big rotation out of technology as part of the valuation reset. Inevitably, it'll go too far and there'll be great bargains, but there aren't really any signs that we're there yet. So year to date, if you ignore the defensive sectors, utilities and real estate and things of that nature, because I think most people are looking for growth, then year to date, the top sectors in the US over the last 3 months have been healthcare, finance, communication services, materials, and industrials. Now, within each of those sectors, of course, you can drill down into some 200 plus industry groups. But there is definitely a change of leadership. So what did well in 2024 is most unlikely to be the leaders in 2025. So that's probably the first key point to remember. So how do we go about negotiating all the uncertainty that everybody is well and truly aware of? And the answer really is just to do high probability things. Now that encompasses many different aspects that I talk about every week, because this video is really more about strategic positioning and how you think. So just do high probability things, and they include aligning yourself with money flows, the importance of looking at where the money is actually flowing rather than where logic would dictate that it should flow, just can't be overstated. Only buy in sectors and stocks that have got bulletproof tailwinds. And despite all the uncertainty, there are some sections that have got pretty bulletproof tailwinds for many, many years to come. So just do that. Completely lose this thought that, and I've seen it written numerous times in recent weeks, that the way to deal with this level of uncertainty is diversification. Well, I just don't subscribe to that at all. That means that you're taking on board some underperformers. Guaranteed they're going to be underperformers. So why would you do that? Why would you devote part of your portfolio to underperformance? Just target the groups that have got the highest probability of continuing to expand their business and continue to expand their margins. Because even in the lousiest of environment, there are still some beneficiaries of that. Really importantly, stop trying to pick lows in stocks that have fallen a long way. Now, that can present some great opportunities, but often the price is falling for a very good reason. So stop trying to do that. It's much, much better to buy current momentum. Sure, try and buy a short-term pullback, 2 steps forward, 3 steps forward, and then 1 step back, and that's when you pounce. But you want to make sure that you've already got existing momentum and that you're not just trying to catch a falling knife. And then manage risk as your priority rather than making profit as your priority, because if you do all those other things first, the profit will just be there if you manage risk well. And managing risk is about your weightings to individual stocks and sectors, the entry process that you use, whether you do it in 1 step, 2 step, 3 steps, and of course also reading the candle patterns to determine what is the balance between buyers and sellers and how is it evolving. So they're all the key things that you can do to negotiate this uncertainty, and that is just light years better than just saying, okay, well, I really don't want to delve into it too much. I'll just diversify across everything and that'll keep me safe. Well, if you look at the indices, which is effectively diversification, then it hasn't kept you too safe, has it? Now, if you are cashed up for whatever reason, you either panicked to dump stock or you had a well thought out execution plan of reducing your exposure, whichever method got you to where you are now, here's some food for thought. Have you started raising your exposure? What did you buy and why did you buy it? Did you buy it because it was something that you just seized on in a media article, or is it something as part of your overall plan, working towards getting your portfolio to a composition, a mixture of different sectors, all the high probability sectors that will stand you in good stead over the longer term? How did you buy it? Did you buy it in portions? Did you buy small amounts? Did you buy huge amounts? Are you trying to guess where the bottom of the market is? All those things. Just have a reflection about the methodology that you use. Are you working towards a predetermined portfolio composition as a guide, which is something that I've done for a long time? I have a picture, it's not a fixed picture, it's dynamic, but I have a picture of what I want my portfolio to roughly look like. And I have all the targets that align with that. And I have a rough idea of where I want to enter those stocks. And I just pick them off as they come along. And that avoids you being tempted into something that might just suddenly pop on your radar. So are you merely responding to snippets of random information that don't lock into an overall portfolio composition that's going to work for you? How probable of succeeding are the businesses that you are buying? Are they based on really good growth fundamentals and the criteria that are important? Wrapping it all up, how are you getting an edge on the market? How are you getting an edge over other investors? So just have a think about those questions over the remainder of Easter, and it may well pay off nicely for you into the future. Now, as always, I say that it's easier to lose money in the stock market, and it's far easier now than in most times. So this is a time where you've got to be very targeted, very clear, and very focused on what you're doing. Now, American stocks, the S&P was down 1.5 for the week, the NASDAQ by 2.3, so it was another negative week, but not for all parts of the market. The small caps, IWM, which is the Russell 2000, was actually up 1.1%. And the equal weight S&P, so this really displays the rotation that's going on. So the big end of town went down, but smaller stocks and equal weight stocks did far better and actually rose. It was a much quieter week on tariff policy. We didn't have Trump on the front page of the press or the TV as much, and that's a good thing for markets. The more he says nothing, the better it is. Last week I mentioned that Nvidia was holding up quite well. Well, the reprieve was somewhat short-lived, turned sour with a change in policy, and that tended to drag the whole semiconductor sector down, and that, of course, tainted all of the technology sector. So not a good week for technology. So the rotation from the Magnificent Seven stocks is very clear. The leading sectors in the very recent term now, the last week or two, we've had a good bounce back from energy last week. Real estate has done well. Materials is now assuming some degree of short-term leadership in America. And of course, gold is doing very well, and I'll have more to say on that shortly. The US dollar was down again, down to the low 99s. So we're holding below 100 now. So that's definitely developed into quite a strong trend. The 10-year yield did back off from 4.5 down to 4.33, but it's still uncomfortably hanging in an area where it could start to rise again. The VIX also came off a bit further, but it's still up near 30, and that's not normally how it works. It spikes hard and then comes back quickly, but we're holding up around 30, and that's indicative of just how uncertain the market feels at the moment. All right, let's go and look at some charts. Just a big picture view. So this is the S&P going back to 1985. So just a reminder, when times are tough and you're concerned that how will markets pick up again? It just seems such a long way to come back. But remember this perspective. When times are tough, this is the big picture. We very readily form new highs and substantially new highs and continue the upward trend. So remember that chart the next time you're feeling a bit despondent about the market. It's really just a time issue. Now we'll start with the NASDAQ, and you can see this is on a daily chart. So we've still got a predominance other than these odd, huge green candles. And that was a massive one that I discussed last Sunday when the tariff pause was announced. But by and large, we've still got lots of red candles. So the market, even though it might gap up, even though it might close higher than the previous session, it's actually trading down during the day. Most of the candles are red. And that's just symptomatic of the sentiment. There is a wall of supply of stock waiting to meet every rally that there is. And that's natural because everybody's pretty nervous at the moment. This is a really interesting chart, the S&P versus gold, and it continues to plummet. So in other words, gold outperforming the S&P very, very sharply. And if we take this back quite a bit in time, these lows here were in 2011, and that was when gold peaked. So we're still a long, long way above that in terms of that ratio. Consumer discretionary versus consumer staples, also an important barometer of the sentiment of the market, and that continues to fall away as well. So nothing has really changed, no surprises from last week. Semiconductors had a big turnaround the week before, but that was pretty short-lived, and so we're heading seemingly down further in semiconductors. If we look at a relative comparison chart, this is on a sector basis, this is the US market with XLP leading the way, consumer staples, so no real surprises there. XLV is second in the pecking order, but it's really heading downwards at the moment. You can see this blue line, lower highs, lower lows, and that applies pretty much to all the rest of the sectors. Finance in the middle of the pack, consumer discretionary and materials picking up just a little bit. So that's where we sit with the US market. Let's have a look at the currencies. So there's the US dollar. We've now broken some pretty important support. You can see we're now back to levels that we're at in 2022. And I'll just widen that view. So you can see there's the possibility we hit in January of 2021, and then again in May of 2021, the US dollar was down around 90. We're now at 99. So there is the potential for the US dollar to continue to fall, and there's quite a way that it could fall yet. So we've got this process of flight from the US dollar, if you like, in full force. And that is going to be very disruptive for global asset markets. The Australian dollar in response has bounced. We broke important support. It looked really pretty dire just a couple of weeks ago. And this is a weekly chart. So you can see the last 2 weeks we've had a very sharp turnaround after that breakdown. So that's where we sit with the US market. If we turn to Australia, our dollar finished at the low 63s. And we've now got a pretty powerful turnaround, and I would say that the pressure is going to remain on the US dollar as long as these trade tensions remain as they are. Now, our index was up 2.25% for the week and is in the short term outperforming the US market. I'm really unclear. I don't have any opinion where the index in Australia will go. Banks are the strongest. So the market in Australia is in a really interesting position. The banks are clearly the strongest, as we'll see, but they offer no value. They're trading at historical high PE ratios, and the chart patterns are at a point where you could argue that the patterns are really deteriorating. So I really struggle to see the value in the broader Australian market at the moment. But on an individual stock basis, there are some terrific opportunities that are not expensive, some very attractive opportunities. So let's just go and have a quick look at the Aussie market and some of the sectors. So there's the ASX 200, quite a good week. But if we go to materials, there's materials where the price is below all the moving averages have now turned over and are heading down, and we're definitely forming lower highs and lower lows. So that's really all you can say about materials index. It's looking still fairly grim. Now, we had a better week last week, and I guess the fortunes of this sector will depend a fair bit on what China does in terms of stimulus policy. There's information technology, so that's a sector that's definitely struggling. There's been not much of a bounce there yet. Healthcare, not much happening there either, where prices are below the moving averages, which are threatening to roll over. There's the banks, that's definitely the best of them. So I guess if you wanted to purely play momentum, then that's where the momentum is, or the lack of negative momentum. But I just don't see any value there, and that's energy, and that looks a total disaster in the Australian market. So that's where we sit here. Turning now to precious metals, this is silver on a daily chart. Came off a bit on Thursday, but clearly had a strong run leading into that. US dollar gold finished at 33.26, but you can see that there was still plenty of buying, even though we finished down, and that is healthy. Actually, the fact that we gave a little bit back on Thursday, because this was really threatening to get ahead of itself. But that is good that buyers continue to come in, and I'll have more to say on gold in a minute. This is the Australian dollar gold price, and that hasn't really progressed very much, of course, because the Australian dollar has gone up. So that's been holding that one back. And Bitcoin, not much happening, pretty much a nothing week in Bitcoin. All right, so materials still got plenty to do. Precious metals was a really buoyant sector, clearly the best of the sectors. Gold was up $92 and over 5,200 in Australian dollars. Now, there are forecasts coming out for $4,000. Last week it was $3,600. Now it's $4,000. That worries me a little bit when you start to see this. So often you get a pullback when you reach this level. When everybody starts to nod and say the same thing, that gold is a no-brainer, inevitably you get some sort of pullback. But look, it doesn't necessarily need to start now. And the trouble is, it's just so fundamentally feasible. But I can't remember a time when I have felt more comfortable with the forecasts, because there are just so many factors that are in favour of gold continuing to rise. And probably more importantly is that the fall of the US dollar and the de-dollarization and the impact that that has on gold is not subject to a valuation decision. People aren't buying gold because they perceive that it's good value relative to some other asset class, as is what normally happens. Central banks are not really that price sensitive to the price of gold. They're buying gold for other reasons. And then, of course, you've also got the dynamic, which we've seen in the equities market for years and years and years, and that's when an ETF spiral starts, it feeds on itself. It becomes self-reinforcing. And we've certainly got a spiral into gold ETFs at the moment all around the world. And there's no reason why that can't continue to feed on itself. Now, eventually it runs out of gas, but who knows? That could take years. The seriousness of where we find ourselves, Trump trying to change the whole world's trading system, is a pretty dramatic event. So, why not? Could gold continue to go to the upside? Gold miners right at the moment, this could prove to be the buy of the century. Maybe it will, maybe it won't, but it certainly looks pretty compelling at the moment. We've got extreme divergence on historical relativity, as I'll show you. It's really quite head-scratching, the level of divergence that we've got. We've got local producers that are doing really, really well. If anyone's been watching the gold sector, you'll know that all of the gold producers are rocketing up in price. But despite that, they remain pretty cheap, despite the very large rises in share price. And that's because the typical all-in Australian dollar cost is around $2,000 an ounce. Now, with the Australian dollar gold price, spot gold price at over $5,000, that's a huge profit margin. And they're stacking cash away like there's no tomorrow. if you look at some of the recent announcements. So it's, absolutely justified, the rises that we've seen. And I'll go to, before I go on to other commodities, so let's go and look at some other charts. So there's gold and silver, but let's go and look at GDXJ, for instance, which is the global ETF supposedly for junior gold miners, but there's a lot of quite significant producers are in this index. Now, I presented this last week just to show the lag in 2011 when GDXJ was trading at $170. The gold price was $1,920. Now the gold price is over $3,300, and yet GDXJ is trading down at 64. Then I started thinking, well, I wonder how much the composition of GDXJ has changed. Could that be confusing the picture? So I went and looked at the VanEck website and looked at the total returns that they were quoting. And over the last 5 years, the total returns for GDXJ is 16.35%. Over the last 10 years is 11%. And since inception in 2009, it's actually lost 1.5%, which sort of validates, because we had a significant rise. So from that point there at inception to where we are now is actually a loss of 1.5% per annum compound. And $10,000 at inception, and this is off the VanEck website, this is not my calculations, $10,000 at inception is now worth $9,494. So we're actually worth less than we were 16 years ago, which is quite extraordinary, really, when you think about it, given how much higher gold is. So this divergence in value is real, and it's really quite extreme. Now, maybe this divergence doesn't close, but it doesn't really have to. If the price of gold even continues to hold where it is, the gold miners are producing so much cash that they are going to get re-rated. The process has started, but there's still potentially a massive amount of catch-up that could happen. I'm not saying it will, but it certainly wouldn't surprise on the basis of historical valuations. So the gold sector at the moment looking very, very interesting. Other commodities, copper has recovered, so we went from $5.25 to $4, and we're now back to $4.60. And nickel is at $7.03, and it's just been extraordinary volatility. And the takeaway from that, of course, is just how leveraged and how stretched financial systems are that you can get that sort of price volatility from $5.25 to $4 back to $4.60 just within a couple of weeks. I mean, that shouldn't happen. That's just not at all natural. Crude oil had a bit of a blip at the end of the week, positive blip, up to 64.5. And of course, that's all being fed by the trade tensions and concerns about global recessions and the like. It was the first weekly gain in 3 weeks for crude oil. This is spot copper chart, huge plunge, and now a very concerted and very sharp rebound. Crude oil similarly gained a little bit of ground towards the end of the week. So wrapping it up, just work with the highest probability themes is my recommendation. At present, wait until they're at relatively cheap long-term valuations, because there are still, even if you look at some of the Magnificent Seven stocks, Amazon and Google and Nvidia, they're still world-dominating businesses. They're not going to suddenly melt away. The valuations are being dramatically reset and will almost certainly overshoot. So even at that very pointy end of the global scale, we are going to get some very attractive entries. I'm just not clear at the moment where that will be, but I certainly know what it looks like in the chart patterns. So sectors and stocks that have got real long-term merit that are temporarily out of favour, that's a pretty good hunting ground. Be clear on your process, have justifiable conviction. We're not talking about hope trades here. We're talking about you've done the research, you've done the homework, and the long-term tailwinds are intact. Just be clear on your process and you should do pretty well. And also too, I think over the earnings seasons, both in America and in Australia, we're going to get plenty of upgrades and downgrades based on the outlook statements. So you want to respond fairly promptly to anything that occurs in that area. Portfolio analyst this week coming. I'm going to dive deeply into gold stocks. That will be certainly one thing that I'll be doing because there is still, despite the rises, as I said earlier, very compelling value there. There's also some sectors that offer absolutely no-brainer growth. And I'm talking about things like cybersecurity, national security, defence, things of that nature. It's almost inconceivable that the tailwinds are not going to continue in those areas. And companies, good companies, not all companies, just because you're standing in the sector doesn't mean you're going to automatically be a beneficiary, but good companies are going to have growth tailwinds. So that's it for this week. I hope you're having a great Easter, and I'll be back with you next Sunday. Cheers.